everyone. Welcome. It is 1 p.m. We just got the closing bell for Wednesday, May 29th. It was a pretty low volume day. We were saying that potentially volume could come back today, but really it was pretty much the same as yesterday or last 2 days after we get that dark pool data coming or dark pool volume coming in. So tomorrow. Tomorrow is our next best chance of getting volume in and getting some direction. Here in the SPY, we gapped down to this lower range, but we never really broke it. And we just kind of traded up to the MA8, traded back down. We didn't really go anywhere. We just very comfortably stayed in the lower part of this range. If we look at the intraday, I guess I don't have it. Is this intraday? This is intraday. Okay, so the S&P, you can see very, very muted action. All it did was trade between this 527 level that we drew, because that was the low of yesterday, and just bounced between that and the VWAP all day long. We didn't really break the VWAP until the very, very end. And is that reflective of something? I wouldn't read too much into it. This is maybe just last second positioning before that GDP report. So really muted, very little range, especially look at yesterday. Today's range was just extremely limited. So it looks like everyone is waiting for that GDP report. Now, if it comes in poor, then it's one of those things where, poor is what the Fed is trying to accomplish. so if it comes in poor and you say, oh, okay, we're in an okay space for us to cut rates, that might be the way that the market interprets it. It won't be true, but it might be the way the market interprets it, and we may get a little pop up. If the economies come in hot, that implies that we could have continued inflation. We could have continued disparity between the pricing power of businesses versus what the consumers can demand. And that would imply that we are more likely to not have a rate cut in 2024, which in my mind, personally, it's pretty much given that we're not going to have a cut in 2024. So really, we might get some direction off of that GDP number. If we do get direction, it is more likely to be downward than upwards, but then we do have support somewhat nearby. So unless we gap below that EMA 20, then it may be kind of limited in terms of how far down we go. It's possible that we gap below the EMA 20. And if we do, then we'll see if we either fill the gap or we trade down to the MA 50. So with muted action on the S&P, what's interesting is that we did still see some movement. For example, in my portfolios, two of the picks that I had for shorts, they went down quite a bit. Unfortunately, we didn't get into position. We missed the movement by a little bit. But for example, Whirlpool, that went down another 2.28%. We missed it because it gapped too much at the open, but that was a nice downward continuation of a downward movement in WHR, which is what? Consumer discretionary. So appliances. So people don't have to buy a new appliance. It's something that they buy when something is really broken, or it's a nice to have to upgrade your existing one. So it mostly falls into consumer discretionary. So consumer discretionary, breaking down right here. And the other one that I had was Caesars Entertainment, which is casinos, Vegas casinos. That also gapped down a bit at the open, and when it traded back up, it didn't quite hit yesterday's close. So we also did not get into that one, unfortunately, because that one was down 3.31%. Both of those would have been a very nice juicy profit in a single day, but unfortunately, we just missed it. That's okay. We can keep on finding opportunities like this, and eventually we won't miss it. So just goes to say that discretionary is doing very poorly ahead of the GDP. So it is the market is not anticipating that those GDP numbers are going to be really great. So, or at the very least, we're anticipating that the consumer is not going to feel really great. And there's this disparity. There's this disparity between sentiment in general. If you poll people, for example, in the consumer sentiment, people are feeling worse. They're feeling the inflation. They're feeling it at the grocery store. They're feeling it at their energy prices, utility bills going up. They're feeling it in terms of their paychecks are not growing as quickly as their expenses are. So we see this disparity between this S&P movement upwards and the consumer sentiment moving downwards. So that is generally a recessionary sign, early recessionary sign. It's actually called a K movement. K movement, because if we just draw a straight line right here, and then this is consumer confidence and consumer sentiment, and this is the stock market, well, eventually the consumer confidence drags down on the stock market and we hit a recessionary period. So because consumers aren't spending. And in the US economy, where over 70% of the GDP is determined by consumer spending, if the consumer stops spending, then the GDP is going to shrink, and which is the very definition of a recession. So, so this is not indicated, though, it is not necessarily immediate. That's about a year or so from now. So we'll keep that in mind. We'll keep a careful eye on that in the longer term view. But for now, it just looks like we might get another pullback. And then there's still potential for this market to continue to move upwards after a pullback and into the election year or election cycle. So probably September, October, and then in November, early November is when we actually get the election. And then, so generally, as we approach that election, we'll see if certain sectors are performing, then that would indicate the Democratic candidate is more favored. And if the other sectors are moving up, then that would indicate that the Republican candidate is more favored. It's not necessarily the overall movement in the markets, although we could check the overall movement of the S&P versus IWM, small cap stocks. That could be telltale whether we are more business friendly or we are more I don't know how to call it, business liberal. Okay, so the disparity between the large cap and the small cap stocks could also indicate a bias towards a particular candidate. And generally, the markets are pretty good at predicting these elections. So we'll pay attention to that as we get later into the summer or into the last quarter of the year. But for now, we're just looking at this sideways movement and seeing if tomorrow we get a break downwards or if we just keep chopping sideways. We could, of course, go up, but that's the lower probability possibility. Let's see what happened to VIX. VIX went up and kept on going up. What did I say? Maybe up to the 15 level. Okay, and we got to 14.27. So this is still indicating that, hey, either we're going to spike, which I think it's too early for that, or we're going to mean revert. And if we mean revert, that is favorable for the S&P 500, which just simply means, hey, we might just go back into this range right here, or towards the middle or top of this range. It doesn't mean break out of this and make a new high. So VIX is saying that, hey, maybe not, maybe we won't get directional tomorrow. Maybe we'll just keep on chopping sideways. If we look at the CPC 0.88, not at an extreme, so neutral, nothing really to conclude from there. Let's take a look at our momentum levels, because I only did that on Tuesday, I think. So let's just take a look at the market momentum. 37% of stocks below the 50-day moving average. Or sorry, above the 15-day moving average. That is not a good look for us to be just a couple days away from the all-time high and really just at the low of the same bar of the bar of the same day. We're just kind of not even at the lows. We're near the lows of the same day that we hit the all-time highs. And only 37% of stocks are above their 50-day moving average, which is way down here, which is very far from all-time highs. That is just emphasizing what we said earlier this week, how this entire market is propped up on just one sector, really, technology. SMH or semiconductors is part of technology. So really, tech is holding this entire market up. And if tech goes, if TLT keeps on going downward, and that can yield is competing with those tech stocks, then XLK goes down, tech goes down, S&P comes tumbling down with it. Right now, the reason why we haven't seen that yet is because NVIDIA is still hot. It's still really well followed, really well bid. We just came off of earnings and we're just popping up today. We went a little bit higher, only 0.81%. Looks like we might be running out of steam. You can see that the volume is decreasing, but price went up significantly. So we could see a pause at the very least, or a mild pullback in NVIDIA. And then if you no longer have NVIDIA, a $2.6 trillion company propping up the market, well, what's going to happen to the S&P? So it still looks like the S&P is really due for a pullback, maybe down to that MA50, maybe lower, but I have no way of determining that until we get to the MA50. So for now, anything below the MA50 is just gray area for me, 50-50. But down to the MA50 is indicated pretty strongly right now, at least 70 to 75% chance that we'll get down to that MA50, which is just a mild pullback, not a big deal. And then we'll see if we can bounce from there or if we feel like that it should move down even further. Given where TLT is, we're about halfway down the channel, maybe slightly below halfway. Before we were talking about, actually this morning, we were just talking about this 88.5 level. It looks like we almost got there just today. So we might actually make it to the bottom of the channel. If we make it to the bottom of the channel, that would correlate with the S&P maybe getting down to the MA50. And so if that's the case, if the TLT then bounces off the bottom of that channel, then probably that'll be it. Well, in terms of the S&P, we'll just hit that MA50 and bounce off of it. But if the TLT falls through, then that's a different story. But we'll see. This is too far in advance and too much speculation. So for now, MA50 seems pretty likely. And let's just see if there are any other sectors other than XLY have joined us in terms of weak sectors that we might consider leaning our portfolio short with. Usually it's pretty instant. Let's try that again. Okay, so on our normal view, looks like we're fairly well, or not fragmented, defragmented, except for this discretionary being way down here. And real estate should be more in the middle. But we're reasonably defragmented, but on a shorter term basis, let's check 1 month. We got a weird mix with utilities up here with technology, defense and retail up here, and discretionary down here. Let's look at the day. Now, what we want to see, okay, so today you see everything is down, which is fine. That makes sense because the overall market was down 0.7%. Market is mostly flat on a 2-week basis. 1, 2, 3, yep, 2-week basis. So we'll want to see on a 1-week basis how these sectors are doing also, 1 or 2-week basis, and compare which ones are not flat, which ones went down on the 1 and 2-week basis. And then we want to see what dropped more than 0.7%. So if we look on the day today, anything more than 0.7% was healthcare and downwards. So healthcare, gold retraced, real estate, bonds, utilities, industrials, materials. It looks like the more conservative ones, and then the discretionary and tech fell less. Okay, so still tech is still propping everything up. It fell less than everything else. Retail is still strong. Consumer discretionary not as weak as, well, same as tech, probably because we have a lot of discretionary stocks reporting earnings today after market, tomorrow before the market. So mostly we don't want to make huge directional moves immediately before earnings, especially when there's so many in the same sector reporting at the same time. That can definitely move around the sector. So it makes sense that XLY was more muted and retail was more muted than the overall market. So I'm not going to count that as strength inside of these sectors. I'm just going to count it as no one wants to make a move immediately before earnings. So if we ignore that and we start looking at what fell the most or fell more than 0.7, then we're looking at utilities, industrials, basic materials. Wow, good. Semiconductors really took a hit today, and energy. So let's take a look on a 1-week and 2-week basis for all of these. Down 3.2, down 1.29. So utilities very weak to the S&P. Industrials very weak to the S&P. XLB very weak to the S&P. Home builders extremely weak to the S&P. And semiconductors still very strong on the week and 2-week basis. And energy is also weak. So let's look at all of these. U, I, B, H, B, E. U, pulling back to the EMA 20 and holding there. So I would want to see if that breaks. I would wait for that to break because it could bounce. This came to the MA 90, so and at a horizontal support. So I would wait for XLI as well. XLB is hanging out here in no man's land. So it looks like XLB definitively broke. So I'm interested in XLB. XHB near horizontals could move a little lower, but it's not that much more. IWM was not one of them. XLE at the MA90. So XLB looks the most interesting to me. So gap down. It could be a pause, but this is general weakness and no real support until this 89, 88 region. So let's see what stocks we have in XLB. Oh, and that VIX trade this morning. Hopefully you guys, if you took the example trade, you guys made some money on that. And TLT continues to perform and do very well. But let's see XLB, finish my earlier thought, and see what we have that's looking weak within the sector. Mosaic breaking down. CF, PPG. That's a little too aggressive. I would wait for that to pull back. That's parabolic. So I would wait for that to pull back. Mosaic and what was it? CF. That's a pretty aggressive move downwards. Also, gap down, move downwards. I would wait for a pullback. And then CF. CF is a lot more reasonable. CF just filled this gap right here, though. Connected. I'd be okay with I would maybe a half allocation on CF, and then if it confirms, then you could go full allocation, or we could just wait for a confirmation. CF, out of those three, look the most interesting. NUE. NUE. I like NUE. Let's do a option strat. Buy a put in NUE. Oops, NUE. This would be. This could trend. So we'll give it a little bit more time. We'll do July 19th. And at the money, 165 put. Yeah, I will save this trade. Okay, so for the most part, we do see weakness in the market, or at least the potential for weakness. We're on really shaky ground right now. It's something that really has to come in and firm this up, like an amazing GDP report that just makes everyone super optimistic, or a super terrible GDP report that makes people optimistic that the Fed is actually going to cut rates, despite all the things they've been saying for the past 2 or 3 weeks. And otherwise, this is looking pretty weak here, and looking very likely that we could at some point hit the MA50. Now, I tend to be right, but I tend to be early when calling these things. So the day that I say it is not the day, it's not like tomorrow or the next day, that's when things happen. Usually it's like a week or two, or sometimes a month before I am proven right. And I just saw things too far ahead of time. So in terms of timing, I wouldn't be leaning my portfolio super short. I would just lean it slightly short. So it's just barely bearish, and then just wait for things to confirm before we get more and more bearish. So for the most part, neutral. The S&P 500 is trading sideways inside this range. We have not broken it yet. So the time to go strongly bearish or even normally bearish is not yet. You can see one of my indicators here that I program. This is something I program myself. I have one telling me that the S&PY is in a strong bull, and another one telling me that we're in a bull. So this obviously is looking only at the current situation and doesn't have a way of looking ahead of time. So if I'm looking just at the current situation, just based purely off of price action, then yeah, we're trading sideways and at the top of an extremely bullish run that we've had right here. So there's no reason for us to get really bearish on this market. We're just saying there might be a little pullback, okay? Just a little pullback. But overall, everything is still looking bullish inside of this market. So you don't want to go full bear. You don't want to go super bear. You just want to have a tiny leaning, or you could just completely ignore it because this is just a temporary pullback. If you're taking a medium to long-term view, you just completely ignore this and say, I'm still bullish, overall bullish in this market, or neutral because we're in this 2-week period where we've been chopping sideways. So I just want to make sure that we keep the context clear and we're clear about what we're thinking. If you want to, you take a one position or a small position leaning to the bear side to take advantage of some of this. So I gave you XLY as examples yesterday, and today an example in XLB. So those will just be single positions in against your entire portfolio, which should be neutral or maybe slightly bullish at this point in time if you're taking a longer term view, if you have a longer view on your portfolio. Okay, so let's take a see. I want to see if any of the earnings reported yet today after market close, sorted by market cap. I thought Costco. Maybe that's this is backwards. CRM. No, Costco must be tomorrow morning. So let's take a quick look. U-Haul, Path. There's a couple of these tech stocks. We'll just go in order. CRM. Can't see it. CRM. Way down. Didn't like what CRM had to report. And then HPQ, PSTG. Oops. Also way down. Up. Up. So our two larger the higher caps were down. These two were up, but if we add up this market cap, obviously CRM has much greater market cap. So net out of all of these, we're still pointed downwards. We'll just go up to the 10 billion, maybe AEO, since that is a consumer discretionary. We'll go down to AEO. So NTNX, OKTA, oops. Down. I'll call that neutral. It is a little up, but not significantly. Interesting that it reversed around, though. They must have said something on the earnings call. U-Haul, Path, AEO. U-Haul. Down, I guess. Not significant. Down quite a bit. And AEO. Down. Initially up and then down. So we didn't like the earnings call. So maybe good. Oh, wait. Well, we're not showing earnings right here, but for it to move like this is indicating that they probably had their earnings call already. So overall, based on the earnings that have been released so far, at least the larger cap ones, we are leaning towards the bear side. So that is so far supporting our theory that we're going to pull back over here. But then the GDP report is also a very major report, and that could change the situation. So we won't know that until tomorrow morning. So hopefully you guys are getting a good look at the market. Remember, the 10,000 foot view is, hey, we're still up. This is still a bull trend. We're just looking at the possibility of a pullback, a mild pullback in that uptrend before we resume higher and make higher highs. All right, guys, that's it for today. I will see you tomorrow morning, and we'll see how the GDP report comes out and how the rest of their earnings are affecting the markets. Have a wonderful day. I'll see you tomorrow morning.